Think forward. Think Research Channel.
Slides, and I'm going to whiz through the markets, the private equity business, the M&A business, what's happening, what's not happening, and what's going to happen. Now, here's the economy. What you have to understand about private equity is illiquid securities. Once you buy a business, you're in it. So you need to have a view of the economy, you need to understand where the economy is, you need to understand where the economy is going, and you need to understand where it was to help you figure out where it's going. So you need to understand that there's business cycles, they repeat themselves, nothing is new, everything's new, it's all the same. So here we have Fed funds. And you've all lived through this, so that's kind of interesting. You'll recall we had this tech bubble blew up right here. The Fed dropped rates, it was a smart thing. They kept them low, they saved the economy from going in the toilet, and then they raised them because things got too good. So now they're up there, 5.25%. And I should tell you, this is the exact same presentation I gave my limited partners in November, so some of this stuff's dated. And basically, the Fed's kept it there since. Brilliant financial management by the Fed. And that had the desired effect. The economy went into a recession down here right after the bubble burst. They dropped the rates. This is GDP. GDP went back up. They said, whoa. As rates went up, they slowly had the GDP come down, and now it's clicking along around 2, 2.5%, 3%, and that's okay. Remember this, very important. Now, you hear all this panic and fear and all sorts of stuff's going on in the economy. This is the only number you ever need to know. I was talking to Jamie Dimon at JP Morgan Chase the other day. That's the number. It's the unemployment number. Forget all the BS you read in the papers. If this number is low, things are good. You might have other problems in the economy. That's the number. If you have a job, you can pay your mortgage. If you have a job, you can spend money, you can get credit. If this number is up there, that's not good, right? Very simple. We're right now around full employment, 4.5%. That's good. The economy's booming. Forget the press. So, now we're here, 2007. Is it going to be, what's it going to be? Okay, so go back again. The Fed stopped raising interest rates, so we're in a place of calm. Unemployment's good. The stock market for a while had boomed back up for the last, 5 months. Everything was wonderful. Last Tuesday or Tuesday before, everybody went oops on the same day, went down, panic. Goes up and down a little, that's all right. You can't go up 5 months in a row without a correction, so don't lose sleep over it. However, you have this problem because of long-term interest rates and mortgages that were giving them away. The housing bubble got overheated, so you got to let some air out of that. Be gentle. We'll get back to subprime mortgages in a minute. But you got to realize that something got overheated. It wasn't the tech. This time it was the housing market. So that has effects. Will it blow up the economy? No. Remember, unemployment is still low, so it won't blow up the economy. But you have other things going on. The price of oil was 70. It's now 58, 59, 60. That's okay. That helps. That helps the consumer. He's got a job. He's paying less for his gas. He's still got low interest rates. Good things. He's spending his money. There's money everywhere. I'll show you some slides. That's what's making the whole thing work. There's excess liquidity in the U.S., in Asia, in the Middle East. There's liquidity everywhere. And people are willing to lend it very, very cheaply, and they're desperate to find enhanced returns. So the question everyone talks about, well, is it a hard landing, a soft landing? It's a soft landing. Don't worry about it. So we had this midterm election. They came. Everyone was annoyed. Threw out the Republicans in the Congress. Now it's the Democrats. Bush still president. A lot of yelling, a lot of screaming. You won't know until the next presidential election, right? But it's out there. It's noisy. It's a risk. It's something you think about. So what does the stock market think? The stock market has been going up ever since. Remember, don't forget the interest rates, right? Interest rates are kind of look like this, right? They went down. Then they started to go up. Why did they go up? Because corporate profits were going up. So the stock market got cheap. So people like that. So they bought more stocks. On the other hand, the earnings are going up. Stocks aren't going up as fast. So the PE is cheap. Again, the last LBO boom was back here before the tech bubble blew up. Look at the multiple in forward earnings. 25, 26. It's 16 now. Cheap. Not so bad. They're giving it away. Remember that. Stocks are not expensive. They're relatively cheap. There are the facts. It's based on projected earnings. So what happens? Well, people re-equitize their balance sheets. So this is 10 years worth of public issuances of stocks. And what you see again is there was a lot here. This was probably telecom companies are all washed away by now. Rates went down, and then you had a little recession. But here, they all re-equitized their balance sheets. So if they had too much debt on it, they went and sold equity. And you can also see that the IPO market's doing pretty good too. So you can go public, and if you're public, you can raise equity. And who went public? This 35% or so up here, these are LBO companies. We took them private. How do you get out? You take them public. So 35% is there. Another 14% are venture capital guys getting out, trying to get liquidity. Half of the IPOs since 2005 have been private equity companies coming out of the box. On the other hand, since interest rates are really low, you should raise as much debt as possible. It's like paying off your home mortgage. If you have a home mortgage at 9% and all of a sudden you get a new mortgage at 8 or 6, let's do that. So not only do the companies re-equitize their balance sheets, they got cheaper debt on their balance sheet. So it's about as good as you can get from a corporate finance perspective in a company. That means, again, it's all historical stuff. These are bond ratings, downgrades. That means you're doing bad. This means either you're doing better or you've fixed your balance sheet. So to the extent that you have downgrades going, more and more downgrades, things are sliding the wrong direction. Here you're building back your balance sheets and things are good. So right about maybe in 2007, you're going to find more upgrades and downgrades. That's a beautiful thing. You should like that as a company. Now what's happened along the lending side of life is banks have stopped being banks to corporations. Banks have figured out that a loan is just a debt obligation. A loan's a bond. I don't want to own a bond if I'm a bank. Let's just underwrite it and sell it to somebody else. So if you go back here, in the 80s and the 90s, banks actually owned loans. And then they found out when the recession comes, you own a loan, you got big losses. If you don't own the loan, but you just take a fee for underwriting it and selling it, not that much goes bad. If it goes bad, it's someone else's problem. So what's happened is there's something called the institutional market, which is this. This is the top part of an LBO capital structure. In LBO, you have bank debt, high-yield bonds, and equity. It can get a little more complicated, but that's it. The bank debt piece, which used to be bank debt, is now switching to this loan market, which is up top, has become something called CLOs. Those are collateralized loan obligations. If you had a bad spin on it, you call it a Ponzi scheme, but it's not quite that bad. But what a CLO is it's another company, a group of investors, borrow 90 cents on a dollar, put 10% equity up, and buy loans. So they've levered up a bunch of levered loans. Sounds like a lot of leverage. And that's what's gone on here. So the stuff that used to be on the bank's balance sheets is now owned by these levered loan companies. Leverage on leverage. That's dangerous. And this here, you can see the banks going from 30 down to about 20%. The same thing with the foreign banks. Banks are saying we're not going to hold these loans, we're going to let other people own them. The funny thing about CLOs is to keep their bond rating, if anything goes wrong with the credits, they have to sell them. Which means once people have to start selling, if they all have to start selling together, that's when things go bad very, very fast and very, very ugly. So this is really a chart that's setting up for whenever it goes bad, call it '08, whenever you guys graduate, that's when this stuff is going to unravel quickly. It's a little bit like, if you want a sneak preview, it's what's going on in the subprime loan market. On the other hand, the high yield market, which are insurance companies buy, CLOs buy, high yield funds buy them, hedge funds buy them, this has also been terrific. So you get the idea that there's money everywhere. There's these new things, CLOs, the high yield market's booming, the banks will underwrite anything, the equity market's alive and well, so there's lots and lots of money. Lots of money is a good thing. That's the second, the end of this year made 2006 the second best year ever for high yield bonds. And I'll get back to high yield bonds in a second. It's what makes LBOs work. This is one of the most important charts. When I say high yield bonds were invented in the modern era by a guy named Mike Milken at Drexel Burnham in the 80s. And a high yield bond was high yield. Typical 12, 13, 14% interest rate. If you got really juicy, you make 16, 17% interest rate. And this kind of looks something like over here. And then in stress times, the rates go up. And in really, really sweet times like now, they're too cheap. It's not high yield. If a high yield bond is 8%, it's just not high. The definition is wrong. High yield should be high. My simple definition is a high yield bond should have 2 digits. Very, very simple. And what's the definition of cheap? The definition of cheap is right here. It's what's the risk premium that high yield bond guys charge? The risk premium is, well, you got the government rate, 10-year governments, and what's the risk premium, the differential? You know, typically it's 400 or 500 points, 350 to 500 basis points more. So if the 10-year treasury is 6, which is not a bad rate, you should charge, you know, maybe 10. When things get crazy, people don't want a lot of risk, like, you know, tech bubble blows up, it goes up, and now it's less than 300. That means they're not getting paid for the risk, but they want the incremental yield because the 10-year bond isn't enough yield. So now they're underpricing risk, and you'll hear more about that in a second. Here's another example of underpricing risk. These are CCC bonds. CCC bonds is rated by Moody's or S&P. The definition is there's, I think, a 15 or 20% chance of default. You're not supposed to start there. You're supposed to sort of, you know, start as a AA or BBB or something, then work your way down to a CCC. These are newly issued CCC. It's a crapshoot, okay? People buy them. People like them. I issue them. They're good if people buy them. So the fact that down here there's no market for CCC means there's no market for high risk. The fact that they're up here doing $15 billion of CCC bonds means there's a huge appetite for lots of risk. And why? Because they're getting a little extra interest rate. But still the extra interest rate isn't high enough, in my opinion. However, here's the problem, which is the good news. The good news is, since everyone's re-equitized their balance sheets and refinanced their debt, and the economy's booming, there's no defaults. So it looks like pretty damn easy. Whatever I've listened to, you know, historically it's around 2%. Again, this is the tech guys all blowing up, 10% default rates. You're now down to less than 2% again. It's like, well, gee, I can buy any bond. They don't default. They don't default in good times. They default in recessions. Right? So again, you got to understand where you are inside the economy. But this, I think, kind of tells you maybe you're kind of at a bottom that's not sustainable forever, right? Cycles. This is even sillier. This is emerging market bonds. You know, Brazil, Indonesia, Argentina, South Africa. What should you charge more than the U.S. Treasury, which is good old AAA kind of thing? 200 basis points more for Brazil? I don't think so. But that's what the market is now. That's what it is. There's something wrong. It's supposed to be up here. I don't know, 500 basis points more. Something more than 200 basis points. Not right. Now, everyone knows it's not right. So that's why you get these little problems like last Tuesday or something the Tuesday before when everyone says, oh my God, we're not right. Sell. This is one of the things that helps, on the other hand. There's mitigating factors. This is asset-backed commercial paper. So that's, we sell cars. We have loans against cars, car receivables. if I was GM, I'd have my car receivables, keep them on my balance sheet, and instead I can securitize them and sell them to someone else and make them into a bond, and I don't have any more receivables. You buy them, you give me 100 cents, you take my receivables. That's an asset-backed car receivable. To the extent that this is really, really high, again, people are buying it, they're buying other people's asset-backed things, and the issuer is re-equitizing himself. He's not stuck with his car receivables. He can sell his car receivables, he can then take the money and use them again, use the money for something else. And it's that recycling that is a wonderful thing when the economy is working well. When the music stops, everything backs up. So again, it's an excellent source of liquidity. Here's where it's going to get you. These bars are credit asset hedge funds. So you know, everyone knows what a hedge fund is, right? A hedge fund, all it means you can go long or short. A normal mutual fund is long only. Short means you can go the other side, you can say sell. Same thing with bonds, that's what a credit-based hedge fund is. There's an awful lot of money looking for a home in debt land, okay? This thing up top, this yellow line, are derivatives. Derivatives are about the most complicated thing there is because no one knows what they are. Derivatives are, let's see, take that car back receivable I mentioned. I'll agree to buy it back from you in 30 days. That's a derivative of the original car receivable. Okay, so now you've sold it to me, and I've agreed to buy it back from you in 30 days. I then turn around, so that's one trade. I then turn around and sell it to somebody else, and he agrees to buy it from me in 14 days. Now there's two derivatives that we just made off of that one receivable. You think you sold to me, you didn't because I sold to him. So if something goes wrong, he comes to me and I go to you. That's complicated. So what all these derivatives are very, very complicated things. Each one, generally, is customized. So unlike a normal stock, 100 shares of GM, I got 100 derivatives of these, I got 5 of those and 12 of these, and they're all different, they're all designer flavors. You can make them as complicated as you want. And what's happened is basically people's back offices haven't kept up with the complicatedness. So the traders sit down and write a piece of paper, stick it in their drawer, boom. In fact, the Fed was so worried that it had a meeting with the banks, and the investment banks said, you guys have got to slow down. You don't know where you are. If the music were to stop tomorrow, your back office is 3 or 4 months behind processing all these designer kinds of pieces of paper. This is a train wreck. So they literally all slowed down and got their houses back in order. But what that line is telling you is A, it's completely unregulated. B, it's back leverage. It's people financing things and not really knowing who the borrower is and who the lender is. So you get yourself in a place where you don't know who the true borrower is, you don't know who the true lender is, you don't know what your total exposure there is because it looks like you owned, in my example, $1 million of car receivables, but you already sold 900 of them to somebody else for delivery in a month. You actually think you only have 100 million or 100,000 left on your books because that's how you would net it. So it's very complicated stuff and it's very opaque. And when things in financial markets get opaque, you really don't know what's going to happen. So the Fed worries about it, the banks worry about it, hedge funds don't worry about it very much, but it's the problem that ultimately will come to roost. So, risk, come back to risk. Huge excess liquidity, right? The excess liquidity means people are trying to chase returns, therefore they've reduced the risk. People are there's terrorism, but if you look back again, there was bombings in London, bombings in Madrid, the markets stayed the same. They didn't move very much. In the old days, it would have been panic. So I think that things are becoming a little numb. Politics is localized. There was a coup in Thailand, I don't know, 3 or 4 months ago. Nobody cared. 5 years ago, markets would have tanked. It's Taiwan. They have coups every now and then. Israel invades Lebanon. Markets move? No. Everyone watched it on CNN. Bank lending. The banks won't be the problem because they sold it all out the back door. So someone else is going to be the problem. And again, they've written derivatives off of it, so it's a little opaque as to who the problem is going to be. On the other hand, there's something called VAR. It's called value at risk. What value at risk is, it's the quant people have figured out, you can actually figure out, based on 100-year models, how much money you can lose in a day, based on a whole bunch of metrics. That VAR, in bad times, you really, really shorten up your risk. The banks and the investment banks have figured out that trading, they can make a lot of money. So they've all dialed up their risk. So they've dialed up their VAR. So if you read Goldman Sachs' annual report, you'd find that their VAR has tripled in the past year. They're making a ton of money, but their value at risk has tripled. Again, think of this relative to other stuff, right? Then you got these hedge funds. You got the PE funds, the private equity funds. I'll get back to them in a second. I love them. But what you're getting slowly but surely is you don't know who owns it, and you don't know what the ripple effects are. Therefore, the end, I hate to be down on you guys, the end's going to come out of the blue. It's not this subprime mortgage stuff, by the way, but it's going to come out of the blue. So, let's talk private equity for a second and mergers and acquisition in financial markets. So once upon a time, there was a recession, right? Remember my chart. I had this recession in 2002. If you're a private equity guy, the best time to buy a business is in a recession because the seller wants the money, the earnings are down, it's harder to get financing, but if you can buy something in a recession and then the recovery comes and you sell it off of higher earnings and higher multiples, you make a lot of money. The perfect storm happened in 02, 03, 04. There were funds that were raised before that, because a private equity fund, you raise the money, you invest it over 3 or 4 years. So if you raise money in 99, 2000, 2001, your coffers are full. You had the recession. You had those huge drop in interest rates, so you could borrow cheaply in a recession, which is kind of not normal. And then all of a sudden, when the Fed said, okay, we're going to raise rates again, and the dust settled, the economy was fine. So if you bought something, all of a sudden the recovery came like that. So you could buy something in 2002, and you could do what's called a leverage recap, which is do a big dividend. You can go borrow more money and take all your equity out 6 months later, and then 6 months after that, you could take it public, and you're a genius. And that's what people did. So you raised your funds, and all of a sudden, what was a normal business where you buy a business for 2, 3, 4 years was a 12-month business. And you gave that money back to your investors. You made 2 or 3 times your money in a year. So your IRR is 150%. You go back to your investor, the state pension fund, and say, we're geniuses, give us more money. And don't forget, the private equity business is probably 6 or 7% of a state pension fund's assets. The rest are public stocks and public bonds. The public stocks during that period have gone nowhere. The bonds have gone nowhere. These other guys back up their truck and say, we have 100% IRRs, and you say, fill the truck. You guys are geniuses. So, the answer is mega funds. This is fundraising of private equity. Again, it's a business. You have to go, cup in hand, say, give me some money, one by one sales. These are private equity funds raised annually. So you see back here in the early 90s, the entire industry raised $20 billion. Over here, maybe $50 billion. Times got tough again. The perfect storm comes, and all of a sudden people are raising just buckets of money. This line is the percent of funds raised greater than $5 billion. Here, the largest fund ever raised was $6.2 billion. My fund was $5.4 billion. It was the biggest fund in the world for 2 weeks. So what happened? This is what happened. This is last year's fundraising. 44% of the funds raised in 2005, 06 kind of thing are greater than $5 billion. Again, these are funds that are $5 billion. The biggest one was 6. So you have guys like Blackstone that's got $18 billion, KKR's raised $15 billion, Apollo's got 12, Providence has 12. They all had 3s and 4s and 5s a mere 3 years ago. So these mega funds have just shown up. So if the mega funds show up with equity and they're giving debt away, you know we're going to buy bigger things. That's just how the world works, right? Again, look at these numbers. This is 2000. Private equity funds are hard to raise and they're very hard to invest. Those are the biggest one. Mine's number 2. And here's where they are now. You can't imagine the difference of having 3 times as much equity because you're going to leverage the equity, I don't know, 5 to 1, 6 to 1. So that these, what's this? This is 45, 55, 65. This is $65 billion of equity. This can buy $400 billion of companies can get bought by those 5 guys. It's unbelievable. It's great. So here's how the business works if you look at it by fund size. There's a half dozen guys up here, the mega funds you read about. There's some guys who are close. There's everybody else over here. Okay? So the market is really getting bifurcated with the mega guys doing mega deals. And by the way, these mega guys used to live over here 5 years ago. So the fact that they all go over here means there's probably less competition in this size because the biggest and I wouldn't say the best, but the guys who really have the biggest franchises have kind of moved out to the Himalayas. So what does all that mean? What the mega funds walk around telling their investors is, look, we're just the biggest. And when you're the biggest, there's less guys that can compete with you. So if I want to buy a business that's worth $20 billion, there's only those 5 or 6 guys that can compete with us. Whereas if I'm in Larry's fund, I've got a $2 billion fund now, there's probably 30 guys who can do that. So there's less competition. So you, Mr. Investor, should give me money, me, Mr. Mega Fund, because I have less competition for businesses. That makes sense. I also have a lower cost of capital than some corporate acquirers because I can borrow with this not high yield debt, right? So 80% of my capital structure is going to be at 8%, and the rest is equity, whereas a normal corporate balance sheet is mostly equity, and he's got a cost of capital of 15 or 20%. So I actually have a lower cost of capital than corporate America. So why is there less competition? Where are the companies? Companies are kind of in a mess. In fact, I'll get back to that in a minute. Let me get to the M&A world for a second. M&A is a cyclical business. Everything is cyclical. If you remember one word here, it's cyclical. Here we are, a nice boom in the 90s. Time Warner deal's probably here. Lost $50 billion of value in an afternoon. And then, oh my God, forget M&A. And now we're back. It's typically a 7 or 8 year cycle. And you're in year 1, 2, 3, 4. So you're 4 years into a 7 or 8 year cycle. That's pretty good time to have a lot of money, isn't it? So here's the LBO piece of it. This is the LBO. If I back up to this slide, this is the M&A market. LBOs are a piece of the M&A market, right? These are the LBOs. And again, put this all in perspective. This is a year's worth of M&A. Let's pick this year, 99. Actually, that's got too many tech deals. 98. The entire year was maybe 60 billion. They did TXU 2 weeks ago. It was 44 billion. Is one deal. Something's dramatically different. What's different is that yellow line. The yellow line is the percent of the M&A market that's made up of the LBO guys now. It's 25%. It's not supposed to be like that. You got corporate America. Where the hell's corporate America, for God's sakes? They're supposed to be here. Corporate America is supposed to be the bulk of the M&A market, and the LBO guys are supposed to be, I don't know, 6 to 10%. It's 25%. It's unnatural. In the world of cycles, it's unsustainable. Again, look at some of these numbers. This was an old slide. This doesn't have TXU on it. It doesn't have EOP, the real estate deal done by Blackstone. These are big numbers. This is all done in the beginning of 06. This was the biggest thing 2 years before. The biggest deal 2 years before was $4 billion. It wouldn't even be on this chart. Magnitude, 10 times the size. A subset of this LBO, of this M&A mania, are those darker ones. The darker ones are going private transactions. Public companies that say, we're done, we want to go private. There's nothing wrong with going private. In fact, I'm going to tell you why it's such a good thing. But to have half of the largest transactions be going private transactions, someone, CEOs and boards, are making a humongous statement about the stock markets. And I know everyone learns about perfect markets. I don't believe in perfect markets. And I actually don't believe in the stock market, but that's a much longer conversation. And we have to have at least a pitcher of beer. So what you see here are the huge rise in going private transactions. Huge. And these are bigger and bigger public companies saying, there's something wrong with the stock market. I don't want to be here anymore. These LBO guys are nice guys. I'll make more money with them personally. And my stock's not going anywhere. So I don't want to be public anymore. The only thing that's supposed to stop that, besides the boards doing something else, are the corporate guys. All right? The corporate guy, the logical strategic buyer, who is yet to show up, and I'll explain that to you in a minute. Here's why you don't really want to be a public company. In a nutshell. Public companies put out their results every quarter. And they have this whole thing where they try to whisper to the street or the analysts, we think we're going to do $1.10 this quarter. All right, it took, revenue, blah, 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 boom, $1.10. And really, they actually thought they were going to do $1.15, so they tell everyone $1.10, and they overperform, and that's a good thing. But every now and then something goes wrong, and the $1.10 that they report is really $1.09. And all hell breaks loose. It's the stupidest thing that happens quite regularly. If it was a private equity meeting, if it was a private company, and we sit around a board meeting, all right, we don't even measure EPS because we don't care. But say the net income was $200 million, and instead of $200 million, it's $195 million. Okay, we sit there, they explain it to us. Maybe some of it's timing, maybe lost some business, maybe had some expenses. Whatever it was, we sit there, figure it out, how to make the thing better the next quarter, and life goes on. As a public company, you miss by a penny, they take your stock down 20% that afternoon. Management is depressed. Employees that have stock options are depressed. It's crazy. Why would you ever try to run a business to the quarter? Businesses are living, breathing organisms. You can't measure it that finely and be right all the time. So this whole quarterly earnings thing is nuts. And that's what ultimately what CEOs sort of said, I just can't handle that. The other thing is, every now and then you have to look at your company and say, we screwed up somewhere along the way. We need to shut some plants down. We need to take a write-off. We need to write off a new product, whatever it is. You do that in the public market where you haven't told people, they crush you. You do that in a private equity board meeting, we say, well, that's great. All right, let's talk about why you made a mistake. Let's talk about fixing it because we're going to own this business for 2 or 3 more years and want the business fixed. So if the answer is, you made a mistake, for God's sakes, let's get past the mistake. It's very hard at a public company to stand up and get past the mistake without them crushing your stock again. So you can't make tough decisions. There's Sarbanes-Oxley, which you can have a whole lecture on Sarbanes-Oxley, but fundamentally, it's really tied companies up. It's made it very, very hard to operate, awful lot of regulation. It's good, but it's just an awful lot of red tape. After the tech bubble blew up, everybody started yelling at the research analysts. As a result, Wall Street fired a lot of research analysts. So that if you have a company that's worth about $1 billion or less, you used to have 5 or 6 research analysts cover you. Now you maybe have 1. Therefore, you don't get a lot of coverage. Therefore, a lot of people don't look at your stock. Therefore, your stock ends up trading cheap. Low acquisition premiums is, look, I don't have to pay that much more to take you private. The corporate guys are away. There might have been a little auction or something amongst private equity guys, so we'll pay a little less than normal. Or not less. I mean, in some markets, you pay a 25, 30% premium. You get it 10% now. 10% over the stock price is really nothing. So it's a pretty good time to do it. All of a sudden, there's this big scandal about options backdating. So you got boards jumping all over their managements, perhaps rightfully so, but they're distracted. The name of the game is they're all distracted. I was at a conference last week in Deer Valley. Jeff Immelt is making a presentation, and he's upset. He's the CEO of GE, for God's sakes. He says, well, we've added $70 billion of assets, and my stock has gone nowhere. It's the same as it was when I got here 5 years ago. And he's added $70 billion of stuff. And the problem is, there was a Jack Welch PE, and now there's a Jeff Immelt PE, and it's lower. So he has to grow in, he has to get the earnings up, even though they keep making his PE go down. He is one frustrated CEO. He'd love to take it, no, he wouldn't love to take it private, but he's frustrated. Because again, the people that buy and sell stocks, they're really not as in tune with the real business because they can't be. They're further away, they're very, very busy. And then you have activist funds. Guy buys 2% of your stock one day, writes you this nasty letter, gets on CNN and says, you stink. Sell the company. Well, who the hell's he? He just bought your stock. And next thing you know, the directors say, what's going on? I said, well, this guy bought 3% of our stock and he's rattling our cage and he's calling you guys bad guys. You add this list up and you go, who needs it? You don't need to be public anymore. If you have all this private equity money on the side and you can leverage up your balance sheet, you just don't need it. If you want to do some of that stuff, it's not necessary. Now, I am a little biased. But tell me this. This is cash on balance sheets in the U.S. companies. The highest amount of cash ever is on the U.S. corporate balance sheets today. It's 25% of their balance sheet is cash. Now, why is that? What are they doing? Again, a private equity guy would never have that much cash on your balance sheet, for starters. But you might say, well, I guess that means you can't invest it in your business, otherwise you'd spend it on capital expenditures. You don't think there's corporate acquisitions, otherwise you'd spend it. You haven't increased your shareholders' dividends enough, so why don't you give it to them? Maybe you should buy back your stock. But what are you doing with your cash? It's just not a good thing to have around, not that much. So I don't understand it. It can make you wonder what happens, because those are the guys with that cash, they're supposed to beat guys like me if a company's for sale, right? They've got cash, they've got stock, all I have is cash and debt, and they don't have the debt, they have cash, they can just write a check. Here's the problem. The stocks aren't expensive, so they can't use their stock. They could write a check. They tend to live with low leverage, which is another philosophical conversation we can have, is what's the right amount of leverage. There was this thing, it's probably in history books now, called pooling of interest accounting, which went away 3 years ago. Pooling of interest was the greatest scam accountants came up with. Company X buys Company B, you issue stock, you just add the balance sheets together, and you're done. Okay. Now, it's just purchase accounting. Goodwill, amortization, affects your earnings, it matters what you pay. Pooling, it never mattered what you paid. It did, but not to the same extent as, it hits your EPS, it hits your deductibilities, things like that. That went away. CEOs are still, their head and boards are still, their heads are spinning from all the scandals, Enron, WorldCom, stuff like that. And you had some huge busts. Time Warner, I mentioned, Tyco, McKinsey will tell you maybe 1 out of 3 or 1 out of 4 deals actually work, so there's an awful lot of risk. So the answer is most companies, and right now we're focused only on strategic deals. And it has to be really simple, right down the pipe. It's one of our competitors, we're going to buy it. There used to be much more cross-border M&A between Europe and the US, and the Europeans are pretty much focused on creating sort of super companies to basically duke it out with themselves. So the banks are consolidating in France before they get ready for the war with the German banks, which are consolidating, and the Swiss banks are ready to consolidate, and the Dutch. Same thing in the steel business, same thing in the auto business. They're all kind of inwardly focused, trying to build these national companies. But so they're not really looking at us. Then the stock option thing is, they're busy they're sitting in meetings with their lawyers instead of worrying about things to buy. We're walking around saying, psst, go private. Come on, a lot of fun. Do that. And the activists are running around just saying, you stink, go private. We'd rather have you pay us an extra $2 a share, go private. So these guys, again, this is what a CEO sits with every day, and as his cash builds up and up and up on his balance sheet. When that cash comes back into the M&A market, that's when the LBO guys' game is kind of over. And by the way, CEOs don't sit in that seat as long as they used to. The average time was probably 8 or 9 years. Now it's 6 or 7 years. And the first thing a CEO does when he gets there is not, let's go do a big acquisition, right? So if you're only in that seat for 5, 6, 7 years, you're just not going to push the acquisition as much as you might have when you expect to sit in that seat for 10 years. So the effect of less corporate buying, low interest rates, and just boatloads of private equity money is akin to a housing bubble. It's a corporate bubble for LBO guys. So what this is purchase prices. The way you measure purchase price in LBO is a multiple of EBITDA, earnings before interest, depreciation, taxes. Again, in the recession, this is when you could be a genius. You bought something at 6 times, you sold it here at 7 times. That's that perfect storm thing, right here. Can't miss it. Remember, debt's getting cheap, equity's getting thrown at you, prices go up. Just look at these prices. Again, a great LBO is you buy something at 6 or 7 times. Now the average is pushing 9 times. People are paying very, very high prices. Take something like Univision, which is, Spanish TV stations. They paid 16 times EBITDA, and they levered it 12 times. That's a lot of debt. Everything has to go right when you do something like that. And here it is. You can see it in, I wouldn't say black and white, purple and green. This is senior debt. This is, again, it used to be the banks. It's now these CLOs. It's other guys. But it's the senior-most part of your capital structure, and people are willing to put more and more of that on there. And they kind of put about the same amount of high-yield bonds on there, and the rest is equity, the top part. That's how you finance it. Basically, with, you add these two, you finance it with more debt. Debt's cheaper. More debt. I feel like Gordon Gekko. More debt. If you put more debt on, you can put less equity in. Again, in bad times when you couldn't have debt, remember the other slide, when this was 6.1, actually it wasn't, the price was 6.1 and it was like maybe 4 times, 3 times debt, you had to put in a lot of equity. Now you can put in a lot of debt, you put in less equity. If I update this chart, and if I talk to one of my favorite bankers, it's now 25% equity. So that's pretty good on the one hand. That also means that you're building something that's it's got a little more risk of blowing up on you. So those CCC bonds being issued. So here, too many lines, but you get the idea. These are years, all right? So start here. The amount of debt to EBITDA goes down, right? Bad. Now we put more debt on it. Good. Not necessarily good, but just more leverage. More senior leverage. First, again, in recessions, we had more interest coverage. Now we're going to have less interest coverage. Same thing here. It's getting worse. Things are getting a little more stressed. You try to be very, very sober when you make decisions. You try not to get caught up in any auction process. A lot of times businesses are auctioned off. You hire an investment banker, have a process. You try not to fall in love with the wrong thing. In the last 5 investments we made, we took less debt on our balance sheets than the market would offer us. If they offered us 6 times debt, we put 5 times debt on it because we are worried about the recession. You try to go with your strengths. Our business, we've got some operating partners, real CEOs in our firm. Used to run energy businesses, telecom businesses, and financial services businesses. So if we stay in those sectors, we'll be fine. I only sort of worry about the stuff that's not in those sectors that we sometimes buy. You just have to always remember those charts, really, because you can sit in a room and everyone think, oh, this is great, let's go, boom, boom, boom. The answer is, let's all calm down, take a deep breath. This is complicated because, again, unlike stocks and bonds, the business is really made up of 3 things. You buy it, you own it, and you sell it. The buying is about finance and valuation work. The owning is ultimately about managing people, and the people aren't the people that you work with, it's the CEO of the company who now works for you. You own them, you own the company, you own all the people, and you have to manage the CEO. Those are kind of egomaniacs. So they're hard to manage. And you have to be able to fire him if he's doing something wrong, and you have to be able to see that. So you need to have very good judgment. You need to be able to not hesitate, because hesitation is the worst thing you can do. You need to be able to convince a CEO to run his business differently and have the ability to say, well, if you don't do it this way, you're the wrong guy. The same thing for the CFO, the head of marketing, everybody in the company. You need to realize when you make a mistake and fix it. And you need to understand economics, because you've got to get this cycle thing right, because there have been times when you look back and you might have made 3 or 4 times your money in an investment, and you forgot the last thing, you forgot to sell it. And then the recession comes, and you go from 3 or 4 times your money, which took you 3 years, to 2 times your money, back to costs as at the bottom of a recession, then you got to build it back up to 2 times to 3 times. So now you had something that was a really good deal after 2.5 years, and now you own it in 6.5 years. Well, 3 times your money in 6.5 years is not as good an IRR, clearly, as 3 times your money in 3 years. So you got to have your eye on the exit. You got to manage the companies that you own, and you got to buy smart. And it's hard to buy smart in a very competitive market. So you just have to buy all right. It's like getting married. And as much as you can get divorced 2 weeks later if you got married in Las Vegas by mistake, you can't really do that with a business. Once you buy this, if you made a mistake, well, if you made a mistake, it goes down. You can't sell it. So typically, on a good day, you're out in 2 years. 2 years is a long time. That's why you got to get that cycle right. Because if you buy something, you leverage it, and the economy goes right down, you've got a problem, and you've got to own it. So we can't trade out of our mistakes. We have to own them. So we spend a lot of time working with our portfolio companies after we own them, creating value, and then we always have one eye on the exit because you got to get out. You got to get all those things right. And you have to get along with the people in your firm, which is also stressful because all these things you can have huge disagreements about what's what. But you got to then yell at each other and have lunch together. Start over again. So it's a very complicated process. So where does that leave us? It leaves us with a couple of things. One, you got these mega funds. They're changing what's doable. Again, think $5 billion fund is now a $15 or $20 billion fund. That means you're buying things 3 and 4 times as big, particularly since they're going to give you more leverage. Then the LBO guys figured out, gee, instead of buying it all myself, maybe I'll get a couple of guys we can all team up together. You put in $2 billion, you put in $2 billion, I put in $2 billion. That's $6 billion. We'll lever it, I don't know, 7 or 8 times. We can buy something for $40 billion. That's how you get these things called club deals. The Justice Department then shows up and says, club deals, I think you guys are colluding. Because you would have all bid against each other. Now you're just one bidder. So who's this company supposed to use the stalking horse to get your price up? So the banks come around now and say, well, you know what? Forget the club deals. We'll lend you the equity. That's the sign. It's like boop, 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 flashing yellow light. They're going to lend us the equity now. So instead of a club deal, I can put up $2 billion of equity. My banks will each take $1 billion of equity. So they'll hold $5 billion of equity, lend me all the money, and assume that I'll help them get themselves out of that $5 billion of equity. They're bank lenders. What are they each putting $1 billion of equity up for? They want fees. They want to be my friend. It's like those CCC bonds. It's one of these yellow lights that says this is getting a little bit excessive. Remember all those activist guys yelling at CEOs? That's like, okay, don't be public. Come on back in. Come be private. The debt that's out there, there's some hedge funds. You guys will like this. There's hedge funds out there that'll lend you the money and hope you default on your interest payment because then they want to take you. These are called wolves. And the loan is called loan to own. It's like the mafia. But there's people out there taking them because they'll lend you that extra amount of money that somebody else wouldn't lend you. Another little yellow light. I talked about Starbucks. Being public is no fun. But this is, if I had to give you one page as a snapshot, this is about where the LBO business is today. You can do anything you want. Size doesn't matter. And the business on top of that has gone international. So the LBOs are in Europe. The LBOs are going to Asia, although the Asians have said, gee, I don't think we like this. The Koreans are suing a group called Lone Star to undo a deal they made a lot of money on. They're saying, you just can't come to Korea and make that much money, so we think it was illegal. There was nothing illegal about it, they just didn't like it. The Chinese are starting to back up from it, saying we don't think we like that either, so there's a backlash coming. In Europe, the German government called an LBO bunch of guys locusts because, this is bad. Europe is completely different than the U.S. They have unions, and they're very strong and powerful, and sometimes private equity guys consolidate plants, lay people off. In Europe, they're a little less flexible about that than they are in the United States, for better or for worse. So this backlash is coming. So what I do every now and then, what I always do at my annual meeting, is I tell them my view of the future. So this is now March, so my meeting was November. We'll see how my crystal ball was. I said soft landing, so far so good. I said not much monkeying around with Fed rates, they haven't touched it. Risk is underpriced, still. Single-digit high yield, still. GDP, right. More mega deals. Well, I think when I said it, it was like the biggest was 25. Now they're at the 44. That was right. More going private, absolutely. IPO market is fine. Default rate, look, I've already predicted 08. Default rates will be up in 08. Stay tuned. Corporate buyers are going to come back. Stay tuned to that also, which is good because don't forget, we sell our business to corporate buyers. So those guys coming back and giving us their money is a good thing. It's bad when we compete against them. And the flare-ups, again, the stuff that goes on in Iraq and things like that, it just doesn't seem to slow down the buyout business. So from my perspective, this is about as good as it gets. So it feels a lot to me like the 1980s. Now, for those of you who don't remember, the 1980s ended very ugly. Very, very ugly. So I hope we're not like there. New definition of big, which is these bigger deals are bigger, bigger, bigger. The feds have woken up. I'm not sure what that means, but it's never good when you wake up the feds. I guess the $64 question, or $64 billion question, is probably, where are you in the business cycle? And I happen to believe that we're fine in the business cycle. And yes, things will slow down a little bit, but that's not the worst thing in the world either. Again, if this is as slow as it gets, maybe a little slower because you get some of the subprime mess. But if this year is the year of the pause, and next year we get back on our horse and everything's fine, that will have been a wonderful pause. What can muck things up? Middle East, North Korea, terrorism, Russia, China, big shock in oils, arms resetting. There's $1 trillion of adjustable rate mortgages are going to reset in the next 3 years. Yeah. If rates stay where they are, it's okay. If rates went up for some reason, that's not so good. I think you will have some big hedge funds that blow up, and the thing about them blowing up is because of that opaqueness of these derivatives, you're just not going to know where it goes. Look at where the subprime loans are. You're going to read in the next, I don't know, day, week, month, about how something that you never even heard about, or thought about, or was related to subprime mortgages is going to blow something up. It's because they wrote a derivative and lent them some money and beep, 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 and it's over there, and people thought it was over here. So that's going to happen. This other stuff, gigantic fraud, internet virus, if you really thought about that whole slide, you'd never get out of bed in the morning. So that's it. That is the stock market, the bond market, the LBO market, a little bit of fundraising market, as well as the future.
For a DVD of this program, including questions and answers not included in the broadcast version, please call Eric Smith at 504-865-5031 or email Eric at esmith11@tulane.edu. For more information about the A.B. Freeman School of Business, its curriculum and programs, please visit our website at freeman.tulane.edu.